As the U.S. housing bust accelerates, let's look a little bit at the U.S. housing market. Unfortunately, you're painfully aware of what real estate is doing here. The U.S. housing decline is now accelerating, with millions of homeowners coming to understand that their houses are not worth what they paid for them. The decline in housing has just begun, with 2 million families expected to lose their homes over the next 2 years. There were 1.7 million foreclosures in the first 8 months of 2007, and in the last half of 2007, 800,000 homes entered U.S. foreclosure, currently at a run rate of 45,000 foreclosures per month. Defaults, foreclosures, delinquencies are now the worst since the Great Depression, with 1 million mortgage defaults expected this year, 2008. New and existing home sales are dropping faster than at any time since the Great Depression. The government is flat out lying by overstating home sales, by counting foreclosed homes as normal homes. Beware of government statistics. Housing prices will fall by 50% or more in some parts of the U.S., especially in the biggest bubble states. And again, the declines that we've seen thus far is a supply and demand issue. There's too much supply, not enough demand. This has nothing to do with the bigger part of what's going to cause a correction in real estate, and that's a jump in interest rates and pressure from the interest rate market. The real estate collapse is taking the U.S. into a Japanese-style recession, or depression perhaps, which lasted 15 years and took real estate prices down 75%, total losses of $12 trillion in the Japanese market. There are $690 billion in interest-only adjustable rate mortgages due for interest rate hikes in the first half of '08. Most are not subprime. There are a total of $1.4 trillion in interest-only ARMs. Over $325 billion of those may default in 2008. As Robert Campbell recently wrote, the more housing prices fall, the greater the bank losses will be. The greater the losses, the tougher banks will make it for borrowers to get home loans. In other words, a credit crunch turns into a housing bust, a self-perpetuating downward cycle. The fundamentals behind the real estate bust. To recap, from 2000 to 2006, banks and mortgage companies were making trillions of ultra-liberal adjustable rate mortgages. These loans went to millions of Americans who had no chance of making payments on those loans to maturity, and no intention to do so, as we'll see. Counting on rising real estate prices to solve this problem, this effectively turned the U.S. real estate market into a system of Ponzi finance, where new debt was needed to service the old. And again, that created a pattern where as long as interest rates were continuing to come down and as long as home values were continuing to go up, you never really planned on staying in your home more than 2, 3, 4, 5 years. You would be able to trade out your equity and move on to a bigger and better home. It's the American dream, keeping up with the Joneses, match and raise you one. Like all Ponzi schemes, it had to fail. And when prices stopped rising, that's what happened, as they always do, by the way. And now it's led to a credit crunch and an inevitable housing bust. It's really simple. House prices rose above income gains, national income gains, and from 2000 to 2007, regulatory oversight of lending practices was non-existent. The more than 25% of homes sold in 2005 and 6 were sold to speculators. This is a problem. In 2006, it was more than 40% sold to speculators. Developers vastly overbuilt the national housing inventories, in part to meet this false speculator demand, i.e. 2 to 3 million units were overbuilt. And even in the early stages of this bust, hundreds of billions in subprime mortgages have already been foreclosed on. 1 to 2 trillion in subprime losses will occur, which, if you look at the numbers, would wipe out most of the capital of the U.S. banking system. Real estate supply and demand are now severely out of balance and can only be fixed by significant price declines. It's worth repeating that a $2 trillion loss is likely to occur and would potentially wipe out the entire capital of the U.S. banking system. What would be required to bring home prices and income back into balance? You could see an income gain of 51% which frankly is impossible in the context of a recession, or alternatively a 35 to 50% decline in home prices, which we see as much more likely. Now, will cutting interest rates solve the problem? Cutting interest rates won't, in our opinion, stop the bust. Busted financial megabubbles do not reinflate to begin with, but long-term rates don't necessarily fall with short rates. In the 7 months from September of 07 to March of 08, the Fed has dropped short-term rates 3%, from 5.25% to 2.25%. But because of tightening in the credit markets, i.e. a credit crunch, 30-year fixed-rate mortgages only fell from 6.3 to 5.8, only 50 basis points. I would call